Today I'm going to explain to you guys why shorting stocks is literally dumb. It's one of the worst moves you can make in the stock market. Generally speaking, if you believe a stock's going to go down or the entire market's going to go down, shorting stocks is still not even your best bet. And I will share exactly what is your best bet in a situation where you think a particular stock's going down or you think the markets in general are going down. I'm going to share what the best option is, and it's not shorting stocks even in those situations. But by the way, if you're a little confused on what shorting stocks even is, it's basically betting that a stock price is going to go down, okay? Most people, when they buy into a company, they invest, they go long, so they believe a company is going to go up. They believe the shares are going to go up. A short seller believes those shares are going to go down for whatever reason, or the market in general is going to go down, okay? And it's fine. That's fine, okay? But it is a horrible, horrible decision, because where do the markets in general go over time? They go up, okay? We know the stock market goes up and up and up. Does it have some rough patches here and there? Absolutely. But generally over time, where's it go is up, okay? So more and more money is always being flooded into the stock market. It goes up and up in value, and that's what happens, okay? Particular stocks may go down here and there. Fine, but that's still not even the best way of shorting a company, all right? So if you short a company, what's your best case scenario? Usually best case scenario for someone that's shorting a stock is like, 30 to 50% return, okay? They make like a 30 to 50% return. Now, the best case, the absolute best case scenario is that a stock goes down 100%, it literally goes bankrupt, and that is your best possible return. Your best possible return is to make 100% on an investment, okay? To make it 100%. And sometimes it can take several years to make that 100%, okay? So you really believe this company is going downhill, right? You place a short position. A lot of times, guys, it takes several years for that stock to actually even go out of business if that's what happens. And a lot of times what happens is a company, gets cheaper and cheaper, right? The valuation on that company goes down and down, and maybe it goes down 50%, 60%. And then a lot of times what happens is a bigger company will just go ahead and pick up those shares. They'll just buy them out, because they think they can acquire them and make some money off that and flip the business or something like that. Maybe a private equity fund. So a lot of times you don't even get down to a place where that company literally goes bankrupt. But if worst case scenario happens and that company literally goes bankrupt, you're going to make 100% on your money, which is phenomenal, okay? You shorted the position, you made 100%. Now, all the time, I hear people think short sellers are smarter. I just watched this documentary with a friend who, he brought over his Netflix and whatnot. And we watched this documentary on Netflix, and it's about this lady that short sold a pharmaceutical company, okay? Which was kind of doing the same type of pricing stuff as that Martin Shkreli guy that's now in jail was doing, where you basically buy a prescription, a certain drug, and then just raise the price at an insane amount. And she basically shorted these shares, and as of right now, she's up something like 92% on her position, okay? She's up huge on it. But she's had that short position for I think 3 years now, okay? So it's taken her 3 years to get a 92% return, which isn't anything to sneeze at. But keep in mind, she's paying interest, okay? When you short stocks, you pay interest. So she might be paying, 3% a year on that. She might be paying 5%. So that knocks some of her gains out right there. If she's been in this for 3 years and she's paying maybe 3%, 5%, maybe more than that, I don't know. We don't know exactly what she's paying. But in interest on that, obviously, the return's less, okay? So maybe she's making 80%. That's still pretty good. That's still pretty good, 3-year return. Let's say she's making 80. Let's just say she's making 92%. Forget the interest. She made 92% in 3 years. Is that really that great? I don't know, guys. Let's just look here, okay? Let's just look at some simple companies in the past year, not even 3 years. Just look at some simple companies in the past year. Facebook, not a hard company to understand, just one of the biggest companies in the world. It's gone up 32% in the past year. Apple, okay, the biggest company in the world, biggest tech company in the world. It's gone up 26% in the last 1 year. Google, it's gone up almost 34% in the last 1 year. We got Nvidia, up 141% in the last year, okay? That kills her return, and this is just in the past year, right? Nothing complicated about that. Netflix, up 120% in the last year, okay? So, when you're thinking about this, you're thinking about shorting shares. What for? What for? It's not your best situation. So maybe you're going to make, 50% or so. Maybe worst case scenario, and you get up to that place where you make 90% or 100% if that company somehow goes bankrupt, and you usually have to hold that for several years. If you were Nvidia stock last year, you made 141% in a 1-year span. In a 1-year span, going long shares, right? And a company like Nvidia is up, 1,000% in the past 3 years. So when you're shorting stocks, you're limiting yourself on such a big scale. You're hoping that company goes out of business. And if it does, yeah, you'd absolutely make money. But I'm just saying, like, going long companies and finding ones that will, explode to the upside and are multi-baggers, there's way more potential out there for you, and you don't even have to pay interest on it unless you're taking out a margin loan or something like that. You don't even have to pay interest on it, right? Now, also, people say, well, what if the market's going south? Or let's say, Fitbit. Let's talk about Fitbit for a second, right? Fitbit, that was a stock that was like $50 a share, and then about a year and a half later, it was $5, okay? About a year and a half later, it was $5. So obviously, if you were short shares, you made 90-something% return on investment in about a year and a half span. That's good. That's absolutely good. Once again, we can talk about you could have been going long some companies and you could have done far better than that. But let's say that's a great situation. It still wasn't even your best bet. What you would have been way smarter doing is going put options, okay? Buying put options. If you bought put options, oh my goodness, you could have made so much money. When this stock was up here at $50, okay, and you buy put options, you could have bought a strike price of probably somewhere around $20. You could have bought a strike price of around $20, and you would have maybe had to spend 5 cents or 10 cents a contract, guys. Maybe 5 cents or 10 cents, each. That return on investment, do the calculation on that. It's a lot bigger than a 90-something% return. It's in the thousands of percent. I can almost guarantee you guys, if not more than that, it might be in the 10,000s% return if you would have bought put options on Fitbit when it was $50 instead of going and buying, because you could have got ones that are a year and a half out. Usually you can get put options or call options up to like 2 years in advance, okay? Sometimes even a little longer than 2 years in advance. So you could have got ones that are a year and a half off, right? And you would have absolutely made a killing on it, guys. An absolute killing on it. You pay 10 cents per contract, and at a $20 strike, and then it goes down to $5. The percent return on that is insane. So even in a situation where you think the market's going to go very south, you think particular stocks are going to go really south, it still makes more sense to usually buy put options. And a lot of times with options, you get way bigger upside, which you would have had with a stock like Fitbit that went down massively, right? You would have had way more upside if you would have just bought put options rather than shorted the shares. Also, you could put in way less capital to potentially make way more money, right? If you want to short shares, then you need to put in as much capital as possible so you can get the bigger gain as possible. With something like buying put options, you might be able to put up 1/10 of that money, 1/10 of that money, and probably still get a chance to make bigger gains if that stock really drops dramatically, guys. So even in a situation where a stock you think is going to go south, it generally even then makes more sense to buy put options on it rather than just shorting shares straight up, okay? And never mind that, right? Never mind that. When you go long shares, what's the most amount of money you can lose? The most amount of money you can lose if you go long shares. If you go long shares, you buy an ABC company because you think ABC company is going to go up, and that company goes down, the most you can lose is 100% of your money. Okay, that's the most. You had $100 in it, it went to $0 and you lost 100% of your money. In a short position, when you have a short position on, you could lose literally unlimited amounts of money because that stock could just keep going up and going up and going up. And finally, you're going to have to get to a point where you have to cover your shares, right? And you could have lost 200%, 300%, 1,000%. Who knows? It depends on whenever you decide to finally cover, right? That's the type of situation you put yourself in if you're shorting shares. So if you get anything out of this video, like shorting shares is literally dumb. It's a bad decision as far as an investing philosophy. It's just bad in general. It doesn't work nearly as well as going long shares. And two, it's not even the best option as far as if you're going to bet on stocks going down. Usually that's buying put options, guys. That's usually actually the best way as far as putting up the least amount of money and making the most money if it really goes down a substantial way, like a stock like Fitbit did, for example, here. So I hope you guys really enjoy this. Hope you got a lot of value out of it. I get questions all the time from people, if I speak negative about a company because they're, losing our competition here or there and I don't believe in them for the long term, people will say things to me, well, why don't you short those shares if you believe, that stock's going to go down over the next 3, 5, 10 years? It makes no sense because what am I going to make? Maybe I make 30%, 50%, maybe 100%. Over a 5-year span? Well, guess what? I could have been in some shares, hopefully, that did Wynn Resorts, one of my biggest investments last year. How much did Wynn Resorts go up in just the last few years? Since that one was my investment about, 2, 3 years ago. How much, it went from what, $50, $60 a share to now it's $180 or whatever in a 2, 3 year span? Why would I short shares? Literally, why would I short shares? It makes no sense. If I didn't believe in a company, I'm buying put options. It's going to make me way more money. I'm going to have to put up less capital in the end, guys. So anyways, hope you enjoy this. Thank you for watching as always and have a great day.